Welcome to TheoTRADE. This is Don Kaufman. It's September 27th, 2024. Just over an hour to go to the cash close here on this Friday afternoon. Ladies and gentlemen, it has been a rather slow week, but get your helmets on and get ready for some volatility because, well, literally that is what is in store right in front of us. Let me explain that and much more here, of course, on this TheoTRADE weekend update. As I was saying moments ago, helmets on. Look, we're going to discuss volatility in quite some extensive nature here in just a moment. Before I get there, sure, I'll talk a little bit about some of the price action that happened inside of the marketplace, or, this week, lack thereof. Not exactly the most spellbinding week that we have seen, but there are some really interesting aspects in play right now, and what's coming right ahead of us, well, that's exactly what we're going to get into. So here we are on this Friday afternoon. S&Ps, where are they? Down some 18 handles, net on the week. This is really, for me, what's worth looking at, what's worth kind of paying attention to. I'm going to zoom into this kind of weekly expected move. And of course, this center line that I'm highlighting, that's kind of where the week started, which is just north of 5,700. And right now we're trading, 5,730, 30 S&P points, which to me is massively unchanged. I mean, for the most part, what are you looking at? Like a 0.5% kind of move right now in the week. It's pretty nominal. When it comes to the QQQ, the Nasdaq, I'm actually going to bring up in the Nasdaq. Yeah, here you go. You can see the Nasdaq actually cracked, hit the upper edge of the expected move, pulled back. It's higher, okay, but kind of mildly so. Obviously, different sectors in here. One being the financials. Interestingly enough, the financials hit their lower edge of the expected move, maybe rebounding a little bit. And last but definitely not least, the energy sector got clobbered early on in the week, bouncing back up, barely catching the lower edge of the expected move. So it's interesting because it's kind of a mixed bag of goods, but overall inside of the S&Ps, when I said, it's been a slow week, I mean, to look at this, a couple of trading sessions in here, it's absolutely nothing. In fact, I think a better way to depict this is to look at the 30-day 1 hour. 30-day 1 hour, let me, is there some real upward momentum in there? No, not really. This is last Thursday, and this is right now, which amounts to absolutely nothing. But as I said a moment ago, there's, get your helmet on. Why? Well, I'm going to describe that right here, right now. Look, it's not worth us spending time kind of prognosticating on price action in here because the price action to me, largely speaking, is noise. I mean, even looking at the bond market, it's noise in here. I think the only thing that's interesting right now is probably something like oil, which, kind of got its clock cleaned a little bit earlier in this week, which is interesting because to me, this points to economic slowdown because there's geopolitical risk at the same time that oil's falling. Think about that, if you will. Oil's falling, of course, well, Saudi Arabia, they're going to pump more oil. Nevertheless, there's huge geopolitical risk, and the market's it's still fading in oil, which again, to me, points to it's more of an economic slowdown that the markets are pointing to. But as I said, there's no sense in sitting here prognosticating about, market bias, market direction over here. The one aspect, though, that I can point to, and as I actually said over here, get ready for some volatility, get your helmet on. That's actually the bullet we're going to start with. And the reason we're going to start there, to me, it is the most interesting player in the room right now is volatility. It's not what you think. First of all, we're going to cruise over to VIX, okay? VIX picked up a little bit today. Now, look, I am aware that the VIX goes up when the market goes down, but the market's going to get down listlessly. Like, look, this is not really the market down. I mean, the S&Ps are down 0.2%, but Don, the Nasdaq is down 0.6%. Those are negligible moves. You have VIX actually headed a little bit up, but people, listen, I'm not a big kind of VIX guy, but it is unusual because you're on a Friday afternoon and it's been an inherently incredibly slow week with volatility actually increasing at the tail end of the week. Here's actually the big player in the room. This is the VVIX. This is the volatility of the VIX. And what this is actually indicating right now, there's big boy hedging going on in VIX itself. So forget about looking at VIX. I'm actually telling you that the VIX options are displaying hedging activity. How do I know that? By looking at the VVIX, their volatility of the VIX itself. And even more interestingly, okay, there is, I'm going to say this as eloquently as I possibly can, a proverbial crap load of options trading in VIX today. Okay, that I'm going to tell you right now. You can watch everything you want about the marketplace, and they're going to, prognosticate about market direction. It's all for nothing. Why did almost 1 million contracts trade in VIX today? Why is the VVIX up so much? Like, the market clearly is seeing risk right ahead of us. Which, before I get into the next bullet point, which I'm going to talk about backwardation over here, I'm going to get all kinds of freaky on us. I want you to know this. Something I usually end these videos with whenever I'm on here, okay, I always talk about like volatility, and specifically I like to talk about SPX. Why? Because SPX, it is the marketplace. Billions of dollars are being traded through here, trillions of dollars on an expiration by expiration basis. And the one thing I want you to see is not where we were, okay? Last week, we had a $75 expected move. Okay, we almost hit the upper edge of the expected move, yada, yada, yada. Look 7 days out. Now, again, normally I kind of save the SPX. It's like the last thing I usually cover. Not today. Not today because this is taking center stage. The volatility really picked up for next week. We're at about a $96, okay, expected move. And if you look at this week over week, you got a $75 expected move this week, a $95, or even it's gone up today. So it can even be $100 by the time we close. It's tough to actually say exactly where this is going to be. But we're seeing volatility moving anywhere from 15, okay, to let's say 25% move, okay, in week over week volatility. That is significant. That means right in front of you, you are going to have fairly considerable amounts of risk. One of the dynamics, of course, people go, well, it's the end of the quarter and there's window dressing. I'm going to cover that in just a moment over here, okay? But that's not what this market sees. Now, let me show you exactly what I'm referencing on this front and why I say helmets on, people, okay? Look, I'm going to point something out. I do not have, okay, definitive reasons. I am going to give you a couple of crazy ideas over here, but this is important, okay? Single most important player in the room right now, no question about it. It's got to be the volatility future. So I'm going to freeze the screen and I'm actually going to bring this into play, okay? Let's go ahead and we're going to close up this left side bar. So what we're going to look at right now are volatility futures, okay? Backwardation, the dynamics, okay, of what they say. It says risk is right here. It's right in front of us. It's right now. Okay, what do we see in here? First of all, I'm going to highlight, all right, the volatility futures that really matter. Here we go, 19 days out. These are the October volatility futures, okay? And then we have 54 days out, which are the November volatility futures. Those are the ones that actually matter. Okay, why do they matter? Those are the ones that actually trade. They're the ones that have volume. What's so interesting in the dynamics right now, okay, and for you, I'm just going to go ahead and unfreeze the screen now and kind of script it up here. We have the OCVol, okay, OCVol, and that's the OCVol future. Now, this is a tangible tradable product. That one's sitting at about, okay, 19. And then, okay, we have over here, we're going to put November vol, the November volatility future, and that one's actually sitting basically at 1830. Now, October has basically 19 days remaining, okay? Obviously, November has about 54 days remaining. Here's the actual question to you. Why is October volatility higher than November volatility? Isn't November the month that has the elections? Yes, of course, okay? In the next 19 days, the risks in the marketplace are greater than they are 54 days out, which at first blush, you're going to look at this and be like, holy crap, that doesn't really make a lot of sense because, wait a second, the election is in, again, November. Right now, I'm going to just tell you a couple of logical thoughts. Pre-election uncertainty. Maybe some of the certainty works itself out in the next 19 days. Okay. By the way, there's no if, and, or, but about this. The volatility is saying it's here and now. In the next 19 days, we're going to experience more volatility the market saying this than we are in the next 54 days, which again doesn't seem to make logical sense. But something may play out in the election in the next 19 days. We may get some clarity in there. There's earnings season. Okay, I get it. I know that earnings are coming out, but I've been through many earnings seasons. That usually doesn't impact this volatility substantially. There's economic data releases, but there's constantly economic data releases. But the economic data releases right now, if you look at this, like we're going to get non-farm payrolls late next week. We're going to have a calendar chock full of nuts. There's like PMIs next week. There's JOLTS. Okay, we're chock full of data drops next week, which to me that definitely makes a difference. So I'm thinking pre-election uncertainty. Okay, earnings maybe to a lesser degree, economic data releases. Okay, maybe a little bit of history in here because October typically carries more volatility. But here's the irony of that. Okay, this one only has 19 days left to live. Okay, which would imply like the big market moves have always come like late October. You know, if you know a little bit about history. So that one I'm not really buying into. Look, the volatility dynamic. There's just incredible amount. Okay, of risk and premium built into the next 19 days. Okay, and you know I've been sitting here and talking to myself about this for a while, and I'm like not entirely sure why this exists. And then I just came to the very simple idea: doesn't matter. Doesn't matter why. It matters that we see it. It matters that we actually notice an aspect like why, you know, look, October volatility is over November volatility. And it just matters that we actually understand and interpret what that implies. And what it implies is it's on right now. Risk is on. You wouldn't know it by looking at these S&Ps. You know, the S&Ps are like, well, it's like it's an all-time high, man. What the hell are you talking about? Okay, it's not what I'm talking about. It's what the volatility is talking about. Okay, and you're not just getting the vol futures up. Yeah, they're coming down a little bit over here, but it doesn't matter. We're going to end today, okay, in some kind of backwardation over here. So again, VIX, VVIX, VIX is seeing huge amount of activity in there. Okay, VVIX is higher. So that means that there's buyers, for instance, of calls. You can see the call activity is absolutely phenomenally large in here. Okay, call activity, 750,000 contracts have traded on calls. We're going to clear over 1 million contracts in VIX today. You got to realize how big that is. I mean, the SPX, okay, the SPX doing like 2 million contracts out there, but the VIX is good for 1 million contracts today, which is unusual given the fact that, you know, look, today, what's going on in the marketplace? Absolutely nothing. There's like an hour left in the trading session. We've only done 933,000 contracts inside of the S&Ps, which is, you know, it's pretty humdrum kind of slow day, but it doesn't matter. There's volatility action going on right now. So that is, in fact, why I'm saying, you know, get ready for some volatility. Now, moving past that, defensive posturing kind of continues. I need only actually come over to like XLU for this. I've mentioned this a lot, okay? But I'd be remiss not to mention this. So I have a trade on in XLU. And the trade I have on in XLU, this is ironic, has actually gone against me. And it's what I've termed, it's the best losing trade I've had this year. The best losing trade I've had this year. And you go, what does that mean? It means this. I'm taking a loss in an XLU trade. By the way, it's a negligible loss. I'm going to lose less than, you know, $450, I think, in the trade. Okay. It's the best loss I'm ever going to take because it keeps bringing my attention to the fact that the XLU, okay, why is the whole world diving into this? Okay. Why is the XLU, which is utilities, right? Why is it up 25%? Why are products like Walmart, okay, up over 50%? It's defensive posturing. It's duck and cover. By the way, I can show this again and again and again in a number of different sectors. But I think that these two products unto themselves, you know, people are like, well, the consumer is not dead over here. And we can look at like XLP. The consumer is not dead. I'm not here to argue that. Okay. I don't care what anybody thinks. Walmart, okay, is not NVIDIA. Walmart is not going to be the greatest tech company out there. Walmart might be beating up certain Dollar Tree stores, but not to the magnitude of a 50% gain. Do you realize the market cap we're talking here? This thing now, Walmart is a $640 billion company. It's a 50%. Okay, so what does that basically mean? Well, you're a $400 billion company. Now you're a $600 billion company, but you're seeing, okay, trade move towards, okay, very defensive areas. And some of those being, again, you know, your Walmarts, your Costco's, your utility sector. And it almost defies comprehension how fast and how significantly these stocks have moved. And that's why I'm calling defensive posturing continues, okay, in this marketplace. Keep eyes on it. There's got to be a reason that we're moving towards utilities, okay, with such a fierce kind of momentum, a consistent momentum. All right, last aspect of this. It is coming into the end of the quarter. Look, I'm not big about what we term window dressing. Window dressing is like dressing the portfolio at the end of the quarter. So what that basically means is when you have a fund manager and the fund manager sends out the quarterly statement, okay, they like to have stocks in there that have performed well over the quarters, because at the end of the quarter, your fund manager has to mail the statement out. So there's a little bit of window dressing going on. It's by the way, that's not up for debate. It happens. Like, whatever has been good on the quarter, okay, you'll see they'll be like, jumping into. If you look at something, you could probably make arguments about Tesla. It was higher, it was lower, but on the quarter, okay, it's ending the quarter relatively strong. There's, again, some interesting aspects in terms of window dressing. Once we get through that, which is basically through Monday, okay, then we're into through Monday, we're into a proverbial crap fest of data again. As I said, you're going to have JOLTS, there's PMI manufacturing, in fact. On Monday, you start coming in later in the week over here. Things are going to get crazy. They're going to get crazy in a hurry. ISM, JOLTS. Okay, I can go on and on and on with all the different data that's going to be coming out. Factory orders, obviously, PMI, that's our PMIs earlier in the week, but the employment situation kind of rounds out the week. And once again, one of the most important things you can focus on right now, okay, it's not the action on the screen day to day. It's not this, oh, the S&Ps are down 8 handles and the NASDAQ's getting hit. Okay, this is noise. Like, look at the advanced decline line today. All right, there's a lot of noise going on. That's it. Okay, what you got to focus on is what's right ahead of you. And what's right ahead of you, it's the volatility. And the volatility, like, look, I don't take lightly to the fact that the volatility is amped up a little bit. You're looking at expected moves over $90. Okay, go a little further out in time, you're going to see volatility starts to kind of rage inside of the S&Ps once again. As I said to you, in the next 19 days, we're expecting more risk in the next 19 days than we are in the next 54 days. And that, people, that is worth keeping your eye on. So, as I said, it has been a slow week, but get that helmet on and get ready for some volatility. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.